Hello, everybody. My name's Drew Demon, and I'm the Devil Stockbroker. Got a quick update on the market for you today on this Friday. We had a pretty choppy day today. We started with our short position, which we are still currently here in the SPY, estimating that we are going to see some downside in the market. We're going to cover some of the technicals and see where we're currently trading at and how we ended on the market today. And then we will go into expectations for next week. So, starting with where we ended on Thursday, we had a big push to the upside right before we closed on Thursday, and this was coming after a major gap down in the market. So a lot of us took profit on our short positions that we had initiated somewhere around here at 396. We saw the market was pushing to the downside, and we managed to catch this initial move after we saw the market rejecting off of several moving averages here at 397 and 50 cents. So we went short on the market here near the top, right around here, and then we traded all the way down in the market up until we saw this big gap down on Thursday morning, grabbed our profit down at the bottom of the market since we saw that it was gaining some strength and the RSI was turning bullish. And then we went long in the market after we got our third bounce off of the bottom. And that was our confirmation to go long and that we were likely going to start moving into a defensive channel, which, as you can see, we did absolutely do. We ended up taking profit as soon as we hit the 200 period moving average on the market that day. And then we closed out our trade and waited for the market to complete. I actually took an early short position earlier on that day and traded down to the downside. And then as soon as we got this little V-shaped recovery shape, I ended up taking profit, stepping out of the market, and then went short again at close. After all of that really busy trading, it seems like today was more of just a chop day. Really, not a whole lot happened. But we did get we did get a very interesting close, I should say, since max pain on the market was actually all the way down at 385. So the expectation from the trading floor was that the market was actually going to make an attempt to sell off towards the max pain on SPY, but we didn't get that. What was really interesting about this market in particular is that the entire time that we've been trading the SPY and the SPY has been moving up, the bond market has also shown yields moving up, which is really strange and uncharacteristic for the market. One of the things that we have been paying very close attention to is the path that yields have been taking, and overall, the yields have been channeling up rather strongly. This is the 3-month T-bills, which are, they're relatively low-risk T-bills. They're usually meant to be used as cash equivalents by banking and financial institutions. We also saw that the 2-year was ripping all day today, and especially on Thursday. That was when we saw a massive surge in 2-year bond yields. And this would normally be bearish for the market, which is, part of the reason why I was going so short the whole time. We're also seeing that the yield curve is going into an even deeper inversion. For those of you who are just seeing this for the first time, this is the 2 and 10-year Treasury yield curve. Essentially, what this does is it tracks a ratio of the yields in 10-year bonds versus 2-year bonds. And when this goes into the negative or below the zero line, 2-year yields have become higher than 10-year yields. And the deeper it goes, the bigger that difference or that spread is. And this has been a very accurate market predictor for the largest crashes and recessions. It's literally called every single recession that we've experienced, such as the post.com recession. It predicted the recession of the 90s. It predicted the 2008 recession. It predicted the COVID recession. And now it's calling for the major recession that we are now currently in, but the government is unwilling to admit. The one thing that was bullish for the market was that the 10-year bonds actually dipped a little bit this past week, but you can see that what we've actually ended on is a bullish hammer candle that is cutting through the 10-period EMA. This is the little white line that you see here. You can see that every time that the market has retraced through to these EMAs, that there has been a big surge in yields very shortly afterwards. And if I were to put the SPY on this, then you would actually see that this has predicted every single sell-off in the market that followed. What I'm essentially saying is that when you see bonds going up, the SPY goes down. And what we see is that the top of the market always happens just as these yields start to bounce. And now we've got this big wicking bull hammer candle on the 10-year bond yields. So this is a big predictor of pain to come in the market. There are a lot of people saying that a bull run is still coming and that we're likely to see continued upside in the market, but there are several indicators that disagree. So I want people to take a very close look at these and do be careful going into the market next week. Here on the charts, I have a ratio chart of the SPY over high yield grade bonds ETF. This is the high yield grade bonds, and this is the SPY. High yield grade bonds are also known as junk bonds. I've used this indicator quite a bit on my channel. Let's take a look at what this is telling us. So notice how every single time that we have had a top in the SPY, it coincides with a top in this ratio chart. And also, you also may notice that the HYG bonds start to sell off before the SPY does. This is actually a very common theme in the market that we've actually been identifying to take big swings on market every single time we see this signal trip. One of the things that coincide with this signal tripping is crossovers on the HYG and SPY ratio charts MACD. So when we see a bearish crossover of SPY over HYG's MACD, we know that the market is threatening to drop. Now, what we are toying with right now is a possible cross to the downside, but we may also be rejecting to the upside. It's really hard to tell so far because right now the market's been bull flagging right on this last move to the upside. Now it's leaving a lot of people really confused and uncertain about what direction the market is going to take. And it is possible that we could see some additional upside in the market, especially considering that the SPY has been trading in a very reliable megaphone pattern that we haven't quite reached the top of just yet. So if I were to draw this megaphone pattern here, you can see that the SPY has had these tops here, here, and we haven't quite reached the very tip of this pattern just yet. So history would dictate that the SPY would need to reach this price level, which is around $410 on the SPY, according to this chart. Now the problem is that I can see that HYG is starting to trend down, whereas SPY is chopping around quite a bit. And we can see that the ratio chart is showing that it's got more momentum to the downside, whereas the SPY is setting up higher highs. So right now, the SPY is so far being really indecisive about where it wants to go, but seems leaning towards the upside. And I fear that this is going to be a bull trap for all of the bulls hoping for a big market rally. So far, we haven't seen a big capitulation. We haven't seen the big wave to the downside where the market does this little chop to the downside and then finally has this big wave crash. We haven't had that yet. And if we lined this up with 2008, you would see that we have had the same number of peaks in the market as the SPY did back in 2008. Starting in October 2007, there were peaks in the market that totaled in a trio, and then there was a weaker fourth peak in the market right before a major cataclysmic crash that occurred in October of 2008. Just to show you what that looked like back then, we had 3 peaks in the market that touched this expanding megaphone top, and then there was a weaker fourth bounce that never quite reached it. There was this gap left in it. And if you notice on the weekly chart, it was trading below its 200 period weekly average before it finally gave up. Additionally, there were several different lows that occurred in the market that are worth taking note of. There was the first initial low after it dropped off of its first peak, and then it had a additional peak in the market. Then it dropped down here. It had another low down here, fourth low here, and then finally the big crash. It had a really big, scary week here, but the ultimate low came down here before creating its new three lowest lows. If I compare that to our current market, you can see that we had this initial low before we reached the peak. Then we had the real peak, which set us up for a very similar low, slightly lower low, then another pair of lows. Now we have set up a additional low in the market that came at the bottom of the MACD and has seen a small rally, about a 15% rally at this point, as compared to this rally, which was actually 18%. So, what does this mean for the market? I think that what this means, and this is just my own opinion, my own interpretation of events, but I think that we are getting very close to the top of the market right now. It's possible that in the next couple of weeks we can see a further push, holiday rally, if you will. It is still kind of on the table, but things are getting really, really spooky out there. And everybody in the market is really nervous because the Fed is rolling off its balance sheet, meaning that they're selling assets off of their balance sheet into the market at an alarming rate. And this is something that I've been saying that the Fed needed to do for a long time. They needed to be selling off their balance sheet. They've been in this like slow roll sell off phase for the first 3 months since they said that they were going to do it, and they were way behind on the amount of selling they needed to do. Now they're starting to make a really big push to meet their deadline and maintain their credibility. And what it's looking like is like a big bell curve where we're seeing the market starting to push ever further downward. And they're selling into this rally that the SPY is experiencing. If the Fed's trajectory is to continue selling into this market, combined with an additional interest rate hike, which they have promised to do in December, then it's very likely that we start to see real pain in the market from major institutions because this is going to come at the cost of credit ratings. It's going to come at the cost of consumer expenditure, which is achieving the Fed's goal of lowering inflation, but it's also putting extra burdens on the general American citizen struggling to make their payments and paying off things with their credit card that they can't afford. Things have gotten so bad at this point that people are struggling to pay for their electric bill, for fuel to get to put in their cars to get to work. They can't afford to keep their cars maintained to get to work, and people are really struggling. We're starting to see surges of people going and taking buses now where that's available, but for other areas where that's not possible, fuel, especially diesel, is becoming so exorbitantly expensive that we're looking at the possibility of all major transportation of trains and shipping industry just coming to a grinding halt. So I want to close with this because it's probably the most important news story that we're going to see in the market, aside from what's happening on Wall Street and from what's happening in Washington, Congress. The price of diesel, which is powering the economy, is still climbing, and the supply is drying up. This article, which was published last week on November the 10th, said that on Thursday, a gallon of diesel fuel in the United States cost $5.36.2 on average, according to AAA. This is down from $5.81 back in June, but still well above the average of $3.64 from a year ago. And these prices are high because the fuel is scarce across the entire globe, especially in the United States, which in recent years became a net exporter of oil and petroleum products. There's just not enough refineries in existence to meet the demand for diesel because it's so high in demand across the entire world for transportation and logistics. And this coincides with the war in Ukraine being the big catalyst for this because most of those oil products that were used in order to refine diesel fuel came out of Russia. So because we're still in conflict with them and they refuse to back down in the face of NATO against the invasion of Ukraine, this is making it basically impossible to maintain diesel inventories. What the market is yet to realize is that diesel powers literally everything. Diesel powers trains, it powers semi-trucks, it powers tractors, it powers farming equipment. It powers literally the entire economy itself. To be clear that the supply of diesel, it was widely spread on social media that there was only 25 days of supply left. That's a rolling figure, so that doesn't take into effect the fact that there's still diesel being produced, but it's obvious to us that diesel isn't being produced fast enough to keep up with the demand, and that's causing the price of it to rise really, really quickly. So while we're probably not going to run out of diesel fuel in just 1 month, we are running out of diesel fuel very quickly, such that it's forcing it to become a higher cost for everybody who needs it. And the biggest problem with this is that the people who need it the most are producing the essential foodstuffs for the entire country, which is causing food costs to rise massively. So if farmers, which a huge portion of the United States is made up of farmland, needs diesel fuel and can't get it at a reasonable price, they're going to be forced to rise their costs. They're going to be forced to raise the cost of their product that they sell. And that's going to go and trickle down to the consumer, which is entirely reliant on farmed foodstuffs in order to keep food on the table. All the processed foods that you get from Tyson Foods or any think General Mills or Post Cereal, Kellogg's, all these companies that are reliant on all of this essential foodstuffs and grains, they're going to start rising the cost of everything. Like we're starting to see cereal go for $5, $6 a box now. And while these costs are starting to rise, the Fed is starting to roll off its balance sheet at a really high pace, which is going to put more pressure on the market. And we're starting to see everything get really unstable really quickly. I have major concerns for the energy sector, which has largely been the reason why the entire SPY has been rallying lately, because the XLE index, which tracks the energy sector for the S&P 500, this has been propping up this market for a long time, and it's starting to falter and waver. We've set up multiple tops in this market on XLE's ETF, showing higher highs in the price while the RSI is in decline, and we've had a bearish crossover, two of them, in fact, on the MACD since we've been rallying on a daily chart. On the weekly chart, we're well overextended, and it looks like the RSI is starting to come back down from overbought. So if the XLE sector starts to take off to the downside because nobody is able to get petroleum products to get diesel, and it raises the cost too high for anybody to buy it, then that's going to see some declines for the energy sector overall. And as it so happens, the XLE sector has finally finished forming a double top formation. So on a technical level, we would expect to see this come back down to retest its moving averages to see if it actually can maintain its lows. Either way, on a technical level, XLE looks like it's about to come down, and this is the thing that's been holding up the SPY this entire time. We're also seeing a topping formation in the consumer staples sector, which shows that the XLY or XLP, excuse me, has now just touched the top of its channel that it's been trading in since this bear market got started. So what should we expect here? Well, if XLP starts to come back down, then that's going to put pressure on all of the essential consumer expenditures, and we're going to see companies that are in the essential industries for food production start to come down. That's going to put a lot of pressure on those companies, and we're going to see that entire sector recess and probably pull the entire SPY down with it. This is also one of the major sectors that's been propping up the SPY. And finally, we have the Dow Jones Industrial Average, which we've had a very similar three-touch top on this big megaphone pattern that it's been creating since this market began. And it had this lower low, but never touched the bottom of its channel. And now we have this evening star pattern starting to develop. This is a weekly chart, by the way. So on this weekly chart, every single time that we have seen an evening star or an inverted hammer candle, such as here, here, and here, we've seen the market reverse, and it was very close to the top. Didn't quite reach the top of this megaphone pattern, but it doesn't necessarily have to. It's very, very close. So while we could see the market push for another week, it's totally possible. Right now, the market is looking like it's so close to its top that for me, the way that everybody's acting and the way that everybody seems so nervous across the entire market and all the sectors are like really wavering, and we're watching money move back and forth between these sectors so quickly, really leads me to believe that everyone's scared and looking for the last chair in the room in this game of musical chairs that we've been playing. The last thing that I will leave you with is the Dow Jones Theory chart, which shows that the DJI, which you can see here represented in green and red, versus the Dow Jones Transportation Sector Index, which you can see here in blue and yellow. There's been consistent topping formations in the Dow Jones and in the Dow Transport. Dow Theory says that whenever there is a lower high in the Dow Jones Transport sector, that this indicates that the Dow is overbought and we're going to see it move to the downside. We're essentially looking for divergence whenever the Dow Jones creates a higher high and the Dow Jones Transport creates a lower high, that we should anticipate big selling to come in the market. We can see a few perfect examples, such as right here where the Dow Jones created a higher high and Dow Transport created a significantly lower high. We're starting to see this happen again, where you can see that the Dow Jones created this bull flag, but the Dow Jones Transport sector started to break down. It was pretty much every single top that we've had in this market, actually. The Dow Jones consists of all of the major industrial sector stocks, especially the top 30 largest cap companies in the world. This is a big deal, and this Dow theory has been extremely accurate at predicting market crashes. We may be very near the end, so I do want everybody to be extremely cautious going into the next week of trading. If you're a day trader, just be ready for some volatility because it's bound to be coming. That's going to do it for today's video. I want to thank you guys for tuning in to watch. If you enjoyed the video, be sure to leave a like, subscribe if you want to learn more, and consider joining Hell's Trading Floor at hellstradingfloor.com, where you can join our Discord at discord.gg/hellstradingfloor. Thanks again for watching. I look forward to seeing you in the next one. But until then, have a hell of a time in the markets.